Let's start off with how you see today shaping up. What's your WEX word of the day?
Oh, I'm going with concentration today. Just a little background on that. The S&P, as we know, is up close to 15%, something like that. If you look at the internals of the S&P, the equal weighted S&P is only up 5% on the year. If you look at the top 5 names in the S&P, they account for 9% of that 15% year-to-date gain. And the top 10 account for 11. So we're really in a situation where the large cap index is being carried by this top group in the index right now.
Okay, so are you worried about the concentration? Because I know you're also bullish on bonds right now, but specifically short-term bonds.
Yeah, so we are, I think, look, the AI boom has delivered thus far. We don't want to be, we don't want to be overweight equities here. We are slightly underweight equities in favor of bonds. We think that the bonds will perform in a better range of outcomes. Thus far, the economy has hung in really well, but we, given where we are right now in the economic cycle, we see perhaps more warning signs over the coming year than we think is priced in. And that's how and why we favor bonds slightly over equities at the margin.
We're about to enter, Q2 earnings season right now. We just mentioned Nike reporting its results after the bell, one of the big companies that a lot of people are looking at. What are your expectations for earnings season? And do you think with so much just, indecision, it seems like, by the Fed about when they're going to cut, do you think earnings season is really going to be the driver of the market, or is it still going to be the Fed? Yesterday, we did our CFO survey. About a third of CFOs, I should say, believe we're going to get that first cut in September.
Okay, so right now we have almost 2 cuts priced in by the end of the year, and about 4, call it, in the coming 12 months. What do I think the driver of the Fed is going to be? I think it's simple. It's their 2 mandates: maximum employment and inflation. So on the inflation side, we had great numbers second half of last year, terrible numbers to start the year. But the most recent CPI was really fantastic. And we have PCE, which is probably the more important print for the Fed tomorrow. So that is going to matter a lot. But one print doesn't make Fed policy change.
Right.
But interestingly, the Fed has brought in to the equation the employment picture recently. So if we did see the employment scenario weakening substantially, I think that could also ignite the Fed on a move.
Quite a bit to watch there, especially in the employment market. I want to get to your picks. One of your picks for us is Broadley Defense. We're going to show the ITA ETF, the iShares U.S. Aerospace and Defense ETF, lagging the broader market year to date, despite a lot of geopolitical uncertainty and tensions and actual conflict. Why are you so bullish on defense right now when we haven't seen a big spike despite all that?
Yeah, so as you pointed out, lagging the broader market, but given the concentration, most things are lagging, with the exception of those top 10, let's just say. But having said that, we like infrastructure because of the spending that hasn't yet been spent, right? Between the Inflation Reduction Act, the Build Better America Act, about $4 trillion in spending has been allocated to infrastructure. Only half of that has happened. So we think this is going to play out over multiple years. We actually have exposure through the alternative space in our accounts, but it's a theme that we like.